For decades, government bonds were treated like cash with patience. Boring, predictable, untouchable. At Silicon Valley Bank, they were not chasing risk. They were trusting time. And time did not cooperate. In March 2023, Silicon Valley Bank collapsed over roughly 2 days. The 16th largest bank in America. Not because of fraud, not because of bad loans, not because they gambled on risky assets. They collapsed because they invested in United States Treasury bonds, the safest assets on earth. This does not mean there were no management mistakes, but the primary failure was structural, not criminal. Remember to like and subscribe. This is the part that genuinely messed with my head as someone trying to invest responsibly. I had always been told government bonds were basically the safest thing you could own, safer than stocks, safer than real estate. So when I realized time itself could turn them toxic, that shook my assumptions. On the morning of March 9th, 2023, a startup founder in Austin opened his banking app. His company had $8 million at Silicon Valley Bank. The balance showed normally. Everything looked accessible. He stared at the number for a long moment. Was it real? Not whether the bank was solvent. Not whether the FDIC would intervene. Just, if he tried to move that money right now, would it actually move? He did not know. Multiple founders later described this same moment. Refreshing the app, seeing their balance, and feeling suddenly unsure whether the number on the screen represented money they could actually use. To understand what happened, you need to know what these bonds actually are, and why trusting them felt completely reasonable. Treasury bonds are loans to the United States government. You give them money. They promise to pay you back with interest. For over 2 centuries, the U.S. government has never defaulted on this promise. This is not new safety. This is not modern safety. This is generational safety. Your grandparents' pensions held them. Insurance companies that paid claims for decades held them. University endowments that funded scholarships held them. They survived the oil shocks of the 1970s, the dot-com crash, the 2008 financial crisis. Through every major economic disruption of the last 50 years, Treasury bonds did exactly what they were supposed to do. Pay back in full. This was not experimental finance. This was not chasing returns. This was how money worked, when you could not afford to lose. When Silicon Valley Bank needed somewhere to park billions in customer deposits during 2020 and 2021, buying treasury bonds was not a gamble. It was the textbook definition of conservative banking. Nothing about this decision felt reckless. Most people would have done exactly the same thing. That is what made what happened next so quietly devastating. Here is what Silicon Valley Bank actually bought. Not just any treasury bonds. Long-term treasury bonds. 10-year bonds. 15-year bonds. Some even longer. The difference matters. When you buy a short-term bond, you get your money back quickly. When you buy a long-term bond, you get higher interest. But you are committing to wait. And waiting, in banking, has always been considered a virtue. Banks are designed to operate slowly, deliberately. Patient capital is safe capital. The entire history of stable banking is built on the assumption that time is abundant. When you commit to a 20-year bond, you are not gambling. You are acknowledging that the best returns come from patience. That short-term volatility does not matter if you can wait it out. That panic is what hurts you, not time. This philosophy survived every banking crisis of the 20th century. During 2020 and 2021, tech deposits flooded into Silicon Valley Bank. The bank invested them in long-term government bonds, paying 1.5% to 2% interest. The plan was simple. Hold these bonds until they mature. Collect the interest along the way. Return deposits to customers when they eventually need the money. This was not a bet. It was infrastructure. The entire strategy assumed one thing. Time would cooperate. You would have 10 years, 15 years, 20 years to wait for the bonds to mature and pay back their full value. There was no urgency built into the model, and that assumption felt completely reasonable. Banks operate on long time frames. Deposits tend to be sticky. Waiting was the foundation of the entire plan. Waiting was what made it safe. As long as nothing forced the bank to sell those bonds early, everything would work perfectly. But that phrase, as long as nothing forced them to sell early, is doing a lot of work. Because once you buy a 20-year bond, you are locked in. You cannot just undo it without consequences. The bonds were safe, but only if you did not need the money yet. In early 2022, something shifted. Inflation started rising. Not slowly, not gradually, faster than it had in 40 years. At first, the Federal Reserve called it transitory, a temporary surge caused by pandemic disruptions. The assumption was that inflation would peak and then fade. Markets priced in temporary. Banks positioned for temporary. The models assumed temporary, but by mid-2022, it was clear this was not temporary. The Federal Reserve, which had kept interest rates near zero throughout the pandemic, had a problem. Inflation was out of control. So they did what central banks do when inflation runs hot. They raised interest rates, not carefully, not gradually, aggressively. In March 2022, the Federal Reserve's baseline interest rate was 0.25%. By March 2023, it was 4.75%. That is a 4.5 percentage point increase in 12 months. One of the fastest rate hiking cycles in decades. Here is the rule nobody talks about until it matters. Bond prices move opposite to interest rates. When interest rates go up, bond prices go down. It is arithmetic. If you own a bond paying 1.5% interest, and new bonds are now offering 4% interest, nobody wants your old bond at full price. So if you want to sell your 1.5% bond, you have to sell it at a discount. The bond itself is still perfectly safe. The U.S. government will still pay you back. But the market value drops, and for long-term bonds, the price drop is massive. Silicon Valley Bank's bonds had maturities of 10, 15, 20 years, when interest rates went from near zero to 4.75% in 12 months. The market value of those bonds collapsed, not because the bonds were suddenly risky. The U.S. government was not going to default. SVB would still get paid back in full, but that payback was a decade or more away. And when depositors started needing their money immediately, not in 10 years, but right now, that created a problem the bank's entire strategy had been designed to avoid. The problem was not risk. The problem was time. Here is when it clicked for me. Everything people believed about Treasury safety was technically correct. The government backs them. They pay back at maturity. They are rock solid. But there was this invisible condition nobody mentioned. All of that only works if you have time to wait. If something forces you to sell early, safety becomes irrelevant. Time itself becomes the risk. Remember to like and subscribe. By Thursday, March 9th, thousands of companies were realizing they might not be able to make payroll. Not because they had lost money, because they could not access it. A finance director at a healthcare startup had 43 employees. Payroll cleared on Mondays. It was Thursday afternoon. She had initiated a transfer to a backup account. The screen said it would process within 24 hours. She did not know if 24 hours would be fast enough. Fear of Monday became the dominant thought. Not fear of the bank failing. Not fear of losing deposits. Just, will my people get paid? The psychological whiplash was immediate. On Wednesday, Silicon Valley Bank was fine. A stable institution. No reason for concern. By Thursday afternoon, people were wondering if their operating accounts still existed. That is not a slow erosion of trust. That is trust breaking in real time. By Friday, California regulators had seized Silicon Valley Bank. The 16th largest bank in America was gone. Over the weekend, there was no official word on uninsured deposits, no timeline for resolution, just silence. Employees were asking their managers, "Will I get paid?" Most managers did not know. By Monday, the government announced all deposits would be protected. But the announcement came after 3 days of not knowing. The rescue came. But the fear had already happened. Weeks later, after deposits were returned and operations resumed, a CFO who had banked with SVB for 6 years moved his company's funds across 3 different institutions, not because of interest rates, not because of service quality, because the word safe no longer meant what it used to. He was not paranoid, he was not overreacting, he had just learned that safety is conditional. And that lesson does not reverse when the crisis ends. Remember to like and subscribe. And personally, this changed how I think about what safe actually means. I used to think safety was about the quality of the asset, government backing institutional trust, regulatory oversight. But SVB taught me that safety has a timer. It only works if nothing forces your hand before time runs out. That is a completely different kind of safety than what most people think they are getting when they hear risk-free. The lesson was not technical. It was emotional. For decades, people believed U.S. Treasury bonds represented the floor of financial safety, the one thing that could not fail. And they were right. The bonds did not fail. The government did not default. But the assumption that you would have time to hold them until maturity, that assumption failed. What stayed with people was not the mechanics of bond pricing. It was the feeling of watching something trustworthy become unreliable. Not because it changed, but because circumstances changed. Trust does not snap back the way it breaks. This is what SVB's collapse taught. That time is not just an asset class risk factor in a textbook. It is the constraint that determines whether safety actually protects you when you need it. And that even when you do everything right, even when you follow the most conservative, time-tested playbook in existence, time itself can become the thing that breaks you. Not because you were stupid, not because you were reckless, because time stopped cooperating.